right now?
Well, we are concerned that the housing market is too hot, and we think that rising rates will definitely dampen demand. It's very disconcerting to think what the housing market would look like if mortgage rates were to rise to as little as 4%. A 30-year fixed rate at 4%, we think would arrest the market, and we would see a significant slowdown. And that's really due to, Melissa, the fact that 2/3 of mortgage holders in the United States have a rate locked in below 4%. So rising rates are really going to impact, I think, overall demand, and the free money party train might be coming to an end.
Ivy, on the high end, which is obviously an important part of the housing, will it have the same effect to those participants?
Actually, I think that it's worse for the high end, frankly, because I think as rates rise and more people are disincentivized to move. So, the same stat, if you look at those people that have a mortgage rate below 3.75, it's 54%. So think about all those people that were fortunate to lock in below 3. They're not going anywhere. So the move-up market will feel it more so, and the second home market will also start to slow. So we think the high end or move up and second time move up and luxury will be more impacted. The affordable product, I think that today home ownership is still a preferred long-term way to build wealth. And I think monthly payments right now are up in the double digits, was really just attributed to all the home price inflation. But I do think that it will dampen affordability for those trying to buy their first time home. But that's where the demand is the strongest right now.
To what extent should the institutional presence within the real estate market be factored in? And to what extent, if at all, does it kind of abate some of the downside risks here?
Well, I certainly think there's a strong bid from institutional investors across many of the smile states, sand states, think of red states. We're seeing a tremendous amount of capital come into the space, especially for build for rent. So what happens is there'll be a tremendous amount of new construction, and the assumption is all those homes will get leased up. We just published a report on the build for rent market. It's a deep dive thematic report. We follow the money. For those of you old enough to remember the movie, The President's Men with the Nixon impeachment, basically $60 billion over the last 18 to 24 months has been announced entering the build for rent space. That's mostly unlevered. So I think we're going to have concentration risks, frankly. And I think markets like Phoenix today are exponentially higher than any other market. And of that 60 billion, only roughly about 20 to 25% of it's been deployed. So I think that the institutional investors love this space, and they're going to keep deploying the capital because they've raised all this money. They have to put the money somewhere. And Resi's a prettier girl of the dance, as I like to say, than any other place.
Within the sector, Ivy, if we do believe that the rising rates and other factors are going to sort of ding home purchasing, is a smart trade to go into rentals?
No, I think the rental market is extremely robust in terms of valuations are at extremely high levels. And I think that the rental market for both multifamily and for single family, we're currently seeing the metrics at peakish levels. So it's hard to imagine, honestly, Melissa, that it's going to get better from here.
All right. Ivy, great to speak with you. Thank you so much. Ivy Zelman, congratulations on the book. We'll look for it. Let's trade housing here, guys. Tim, what do you think? I mean, the argument has always been that the tight supply is going to offset any sort of increase in mortgage rates that we see.
Right. Well, so the home builders are not necessarily investing in home builders is not necessarily investing in the housing market. We've talked about ancillary and adjacency investments in everything from HVAC to home furnishings. Big hits in Restoration Hardware, Williams-Sonoma today, and even healthy pullbacks in Home Depot and Lowe's. Those Home Depot and Lowe's are pullbacks I want to own. On the home builder side, a couple of things that Ivy talked about are concerning to me. This land inflation dynamic, where they have to chase to actually lock in land banks, et cetera, I think ultimately could be setting some of the home builders, albeit with much better balance sheets than they've had in a long time, to a place where I think they may be setting themselves up at a time when affordability really is the big issue. I think if you're looking at the overall dynamic around people having equity in their homes and consumers being robust, I think that's a trend that are going to continue to follow, and you would still want to stay in home improvement names and ancillary. Home builders arguably have been dead for 6 months or longer, despite the fact that these companies have incredible order books and have talked about, despite some input cost issues, that their businesses are as sound as they've been in a long time.